Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. The dynamic tech duo of Meta and Microsoft added their names to a busy earnings week in the US and played a major role in leading US market indices lower. Yes, they are that big that they can put the entire index under pressure, and they have run that hard this year. But does this little sell-off in any way impact my long-term thesis on both companies? Well, I thought I would cover that in this week's Supernatural Stocks. Now, starting with Meta, 3.2 billion, that's with a B, people use one of their apps every single day. It's really difficult to actually comprehend that kind of scale. Suffice to say that I find it kind of weird now when someone actually calls me normally versus calling me on WhatsApp. And perhaps an even better sign of the times is that a generation younger than me simply find it weird when someone calls at all, full stop, WhatsApp or otherwise. They are the instant message generation. And these technology companies drive consumer behavior, and they do it in a way that benefits them over time, which is a big part of the thesis here. Even when Meta goes and introduces something that seems a bit random, like Threads as a competitor to X, it can almost look like a failure in comparison to the rest of the group, which is so strong. And yet, Threads has 275 million monthly active users and is signing up 1 million users per day. That clearly is not a failure. Now, this massive distribution power into everyone's smartphones positions Meta perfectly for AI improvements in things like feed recommendations. They reckon there's an 8% increase in the time spent on Facebook and a 6% increase in the time spent on Instagram, all because their AI is doing a great job on recommendations. I do, however, on the AI side, remain a lot more skeptical on wearables. Despite the partnership with Ray-Ban, who happen to make the coolest sunglasses ever, thank you Top Gun, I'm just not sure that there's really demand for these AR glasses. Yes, there will always be those early adopters and those people who really love new tech, but on the whole, is this a product that people are actually asking for? We'll have to see what happens over the next decade, because the tech world is desperately seeking the next big hardware win after the smartphone. And Meta certainly wants a piece of that action, because they actually missed out entirely on smartphone hardware. They made all their money from apps in the past decade. Moving on to Microsoft, we find an excellent example of a company that should stay as far away from hardware as possible. They have a really patchy track record in that. But the rest of the business needs little introduction. They are the powerhouse that sits behind enterprise software used by companies across the globe. Microsoft is a perfect example of a group that very few of its customers can actually function and live without. And that is powerful. Moving on to the financial performance in the latest quarter, and starting with Meta, the third quarter saw them grow revenue 19%, while expenses were only up 14%. Now that is great news for margins, obviously, because revenue is growing faster than expenses. And the even better news, I think, is that they are spending in the right place. General and administrative costs were down 10%, and research and development costs were up 21%. Now, isn't that exactly what you want to see as a shareholder? More money going into R&D rather than overheads? Meta's headcount was up 9% year on year, so they are hiring again, but at least not at the insane levels we saw a couple of years ago that got their share price into serious trouble. Lessons have been learnt by Zuck and friends. Another great element of their story at the moment is their growth in emerging markets. In terms of where the users of the app are located rather than who the advertisers are, Rest of World was the fastest growing segment with 23% growth. That is quite a lot higher than North America at 16%, although it is well worth highlighting that 16% is still an exceptional growth rate for the North American market, as mature as it is. How is Meta generating this revenue growth across the world? Well, the total advertising impressions, that's the number of times the ads are served across their services, that increased 7%, and the average price per ad, that was up 11%. That is sheer bliss. Pricing and volume growth together do wonderful things. And WhatsApp is still a small part of the story at Meta, but is growing quickly. The family of apps segment reported revenue of $40.3 billion. Within that, other revenue was only $434 million, so basically 1% or a little bit over that. And most of that is WhatsApp business, where companies are paying Meta for the privilege to use WhatsApp to communicate effectively with customers. And I think that's a powerful story. Reality Labs is the segment where you will find Meta's hardware ambitions, and this is where it could still go pretty wrong for them. Revenue was up 29% and expenses were up 19%, so at least we have the right trajectory for margins. But with operating losses of $4.4 billion, it remains a very, very expensive project. They try to position this as investors needing to see Reality Labs as having knock-on benefits for family of apps where the cash is being made, rather than Reality Labs having to work on a standalone basis. Now, investors would need to believe in this thesis to, stay invested in Meta at this level, because Meta is not going to slow down their spend on Reality Labs. In fact, they are going to accelerate it. Their words, they describe it as operating losses at Reality Labs to increase, and I quote, meaningfully year over year. So, no slowing down there. But overall, this certainly doesn't sound like a rough set of numbers, does it? It sounds like Meta actually did really well. And yet the share price fell 4% as the market digested these results. A cooling down period was badly needed for the share price, with Meta up more than 80% in the past year. Over 5 years, their compound annual growth rate, or CAGR, is up 24.8%. The core business is absolutely cooking at Meta, and I am a very happy shareholder, notwithstanding this little sell-off after the latest numbers. Now let's do Microsoft, my absolute favorite stock in the world. Revenue just grew by 16% and earnings per share was up 10%. Not bad for a juggernaut that touches practically every part of our day. Unless you are trying extremely hard, it is very difficult, practically impossible really, to avoid a Microsoft product in a commercial context. Much like how you will really struggle to avoid Meta when it comes to just going about your daily life and engaging with other people. Microsoft Cloud grew revenue 22% and Azure won market share. Copilot Enterprise, that grew its customers 55% quarter on quarter, never mind year on year. Obviously, I'm just picking out some stats here, but it gets the point across, I hope. And Copilot is one of the best use cases for AI in the market thus far, in my view, with genuine productivity enhancements that are leading to large corporates rolling the technology out across hundreds of thousands of users. Nearly 70% of the Fortune 500 use Microsoft 365 Copilot, which is a lovely little data point that shows exactly why I'm invested in Microsoft. Their customer base is beyond powerful. And it really is worth pointing out just how strong Microsoft is in responding to competition. Remember Zoom? And when everyone discovered it during the pandemic and the market assumed it would grow forever, then along came Teams, casually bundled in with Microsoft 365 that everyone was already using. Today, 75% of Teams enterprise customers buy premium, phone, or rooms from Microsoft. And the Zoom share price, well, go draw a chart for yourself, but you'll need a strong stomach. I always have to mention LinkedIn as well, which is also part of Microsoft, where they are no doubt feeling #blessed and #humbled with revenue growth of 10%, ahead of expectations. That business just keeps on ticking higher with a completely different underlying exposure to Meta's social apps. They are not targeting FMCG type advertisers. It's all very much about commercial advertising, as anyone who has used LinkedIn will know. Now, it can't all be good, obviously, at Microsoft. There is some margin pressure in Microsoft Cloud with gross margin down 200 basis points. However, it came in at 71%. So that's not exactly a chicken business or a retailer now, is it? Over at gaming, also not fantastic. That grew 43%, but that was entirely attributable to the acquisition of Activision Blizzard. It looks like Xbox content and services revenue did grow over and above that acquisition, but that growth seems to have been offset by the hardware pressures for the total move to make mathematical sense. They don't say it bluntly at Microsoft, but that's really the only way it can work out. And of course, this points to what I was saying earlier, that if Microsoft just stayed away from hardware, things would be better. And I'm a little bit worried about Meta for much the same reason. That for me is the strongest bear argument over at Meta. And like at Meta, the share price at Microsoft took a breather after these numbers came out. It was down 6% the day after results. This takes the year-to-date move to around 9.5% in dollars. With the rand strengthening by roughly 4% year-to-date against the dollar, Microsoft's performance this year has actually been quite tame for me. But it's okay, because I plan to hold it forever, and the 5-year CAGR is 23.6% in dollars. Even Microsoft is allowed a breather every now and again. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.